They've grown earnings consistently faster than the S&P. I think they're going to be one of the winners around AI.
Is he saying here that Nvidia will lead the next big rally?
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high.
Is the market stronger than it looks? But here's the investment signal that matters more than the 7% itself. It's the context around it. Because Tom Lee didn't just show up on television today to talk about one stock on one day, he showed up with a thesis, a specific, structured argument for why this rally has more fuel left than almost anyone realizes. And the foundation of that argument is something most investors are going to instinctively push back on.
The seventh black swan now thrown on investors since 2020, and now we've seen that the U.S. can handle a Middle East catastrophe, one where the strait is closed and oil's not available. The U.S. economy is still operating while other countries are talking about shutdowns. And
7 black swan events since 2020. A global pandemic, supply chain collapse, the fastest interest rate hiking cycle in 40 years, a regional banking crisis, and now a full-scale Middle East conflict with oil supply directly at risk. And most investors are exhausted. Most portfolios have been rebuilt and rebuilt again. And the instinct right now, the completely human instinct, is to assume that the next shock is the one that finally breaks it. Tom Lee is saying the opposite. He's saying the United States economy just proves something structurally important, that it can absorb shocks that would cripple every other major market on the planet. That's not optimism for its own sake. That's a pattern observation built on data. When a market proves it can handle the worst case scenario and still push higher, history says the next leg of the rally tends to be the one that catches the most people completely off guard. And the people who get caught off guard are almost always the ones who are waiting for more certainty before getting back in. Certainty that never comes, because by the time the picture looks clear, the move is already over.
The Nasdaq is trying for its 11th straight positive day. It'd be the longest streak since November of 2021.
The longest winning streak the Nasdaq has put together in years. Now, a lot of people will look at that number and read a warning. 11 days up in a row, that sounds like a market that's overbought, overextended due for a pullback, and those people will sell or stay out entirely. Here's what Tom Lee is actually pointing at. When a market strings together a run like this after months of heavy institutional selling, it's not retail investors pushing prices up on excitement alone. It's the big money, the funds that manage hundreds of billions, the desks that actually move markets, quietly repositioning ahead of the next leg. 11 consecutive positive days doesn't happen on sentiment alone. It happens when sophisticated capital decides the risk-reward has fundamentally shifted and starts putting real size to work. And when institutional money rotates back into a market, it doesn't spread evenly across everything. It concentrates. It flows toward the sectors with the strongest earnings growth, the widest competitive moats, and the most defensible long-term positioning, which is exactly where Tom Lee's argument lands next. Now here's what almost nobody in the financial media caught. When Tom Lee named the sector he expects to lead this rally, he didn't just say technology, he said something far more specific. He said technology is the most under-owned it's been in a long time. He said it almost like a footnote. The anchors moved on. The chyron changed. Most of the coverage completely ignored it.
JP Morgan's correct. I think tech is growth when people are worried about growth. And of course, it's also been the most under-owned group because that's the group people were selling.
When institutional investors abandon a sector, when funds that collectively manage trillions of dollars reduce their exposure, rotate out, and sell, valuations compress. Prices fall. And on paper, the stocks start to look cheaper. But what's actually happening isn't value destruction, it's opportunity compression. The spring is being loaded. The historical pattern here is one of the most reliable dynamics in all of markets. The most violent re-rating rallies in any sector almost always follow periods of maximum institutional under-ownership. When the big money returns, and it always returns to sectors with real earnings, real growth, and real competitive moats, it doesn't trickle back in slowly, it floods in fast, and the stocks that benefit most are the ones sitting at the direct center of the most important technology investment cycle of the decade. Artificial intelligence. Think back to the very first clip in this video. Tom Lee said one thing about artificial intelligence that the financial press completely buried. Now let's connect exactly what that means, because it changes the demand picture for one company in a way that most Wall Street models still haven't fully accounted for. We have a market that just absorbed a 7th consecutive black swan event and pushed higher. We have the Nasdaq on its longest winning streak in years, driven by institutional repositioning rather than retail speculation. We have Tom Lee saying technology is growth when people are worried about growth. and we have a sector that is historically under-owned, which means the rotation back in, when it fully arrives, will be fast, and it will be concentrated. The question is, concentrated where? Tom Lee answered that too, because when he talked about what leads inside technology, when he named the companies within the sector that actually outperform, he pointed to businesses with true competitive moats, companies that have grown earnings consistently faster than the broader market, companies where the artificial intelligence spending cycle isn't just a tailwind, it's the entire investment thesis.
These companies have true moats. They've grown earnings consistently faster than the S&P.
A moat isn't just a competitive advantage, it's a structural barrier, something that makes it genuinely difficult or economically irrational for a competitor to displace you. And in artificial intelligence hardware, Nvidia's moat isn't just wide, it's the deepest one in the entire technology industry. Nvidia's CUDA platform, the software layer that developers use to write code for Nvidia's graphics processing units, has been embedded in the foundations of artificial intelligence research for over a decade. Thousands of artificial intelligence models, millions of lines of code, entire research pipelines built directly on top of it. Switching away from Nvidia isn't just expensive, it's structurally painful in a way that most competitors fundamentally underestimate. You don't just swap out the hardware, you rebuild the entire software stack from the ground up. Nobody does that when the alternative is simply buying more Nvidia. That's what makes Nvidia the specific answer to Tom Lee's question. When institutional money rotates back into technology, and based on everything Tom Lee laid out today, that rotation is already beginning. It's going to seek out the companies with the strongest earnings growth, the deepest competitive moats, and the most direct exposure to the single most important technology investment cycle of the next decade. Nvidia sits at the intersection of all three simultaneously. No other company in the market can say that right now.
I think they're going to be one of the winners around AI.
And the reason he can say that with conviction isn't speculation. It's because the numbers already support it. Earnings growth that has consistently outpaced the broader market. A software moat that competitors have been trying to crack for years without a single meaningful breakthrough. And an artificial intelligence infrastructure build-out that is accelerating, not decelerating, despite everything the macro environment has thrown at it this year. The 7% move today was a signal, not a destination. When institutional investors are historically underexposed to the sector with the best earnings growth in the market, and that sector starts to move, the first 7% is almost never the last. It's the first indication that the rotation has started, and once it starts, the historical data is clear about what tends to follow. Tom Lee called the bottom when the crowd was certain the market was broken. He called the Nasdaq's recovery when the bears were loudest. And now he's sitting on television telling you exactly where the next leg is going, which sector leads, which companies carry it, and which single artificial intelligence winner captures the most upside when the institutions finish repositioning. The only question left is whether you're in front of that rotation or watching it from the outside.